Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on November 14th, 2022. Today, as always, I'm going to review. We had a busy week last week, a good one, a real learning week or lesson week about how to manage positions to specific goals. We're trading tomorrow at 11 East Coast time. And I want to take a look at, I'm using the term winning loser, and that's Sunrun. Some of you may already be in the position. Some of you may want to know why I'm talking about something called a loser. You'll see. So we were busy. We opened and closed some trades. We closed some trades from the week before. I want you to look at the right-hand column, and you can see the rates of return were 0.6, 0.6, 0.6, 0.6, and 0.5. And this really indicates a couple of things. We're hitting our goals, which is 0.5% for a position when we close. But more importantly, it's an indicator of the kind of volatility that we're seeing in the market. I want to get out of the way of it. So we hit a number, we take the profits off the table, and we move on. We actually rolled a couple of positions, opened up another position on Sunrun because we've been sitting out for a while. And these are the potential or the actual rates of return that we're seeing over there. The role for Marvel was to catch appreciation. So what you see here and what you'll see when we talk about cash rates of return on capital does not include our moving up a strike price on a call with what I call capturing realized appreciation. What's realized appreciation? Stock goes from 40 to 43, you roll a $40 call to the 41. It's still below the actual share price, and that's realized appreciation. So that was a bit of a drag on the numbers, but on the other hand, it was very, very good for the management of the position. So overall, last week to goal, it looks like we missed, but if you combine it with the 50-something% from the week before, which is the way you really need to do things, you can't be arbitrary and just look at 1 week. We're doing quite well, and we're well above our targets on the cash rates of return for the entire year. And we'll just break it down for convenience. You can see where the cash is coming in. So the rolls are very important. They're, again, 0.5%, which is high, actually. I target a lower rate of return for rolls because of our familiarity and being wed to that position, especially the 4 core stocks. And what was the backdrop for all this? The election hit and bounced off, meaning it wasn't a big deal. In fact, I believe the movement that day after the election was much more related to the issues with FTX, which eventually declared a bankruptcy. But things became very evident that day. And there continues to be spillover from crypto into bonds and equities, but less than it was a year ago because so much money has been lost in the crypto market, and many institutional investors have just simply gone away. Then better than expected numbers hit the market, and the market went poof, and poof in a good way, upstairs, up the escalator. And what does this mean? It means you can't ignore what's going on in the market. Everybody likes a great tailwind. Everybody dislikes a headwind. But these exogenous events, and that's exactly what they are. Elections are exogenous. A crypto company is exogenous, and an inflation rate's exogenous. Just reinforces that the market's uncertain about itself. That means it's going to be more volatile. We're going to sell more strikes that are further out of the money, and it means we're going to be much more religious about closing to goal, which was on that slide, which showed the 0.6, 0.6, 0.6, and 0.5% rates of return. It all adds up, market conditions on how we manage the tactics we used. And the Biden-Xi meeting is going on today. And I think it's important if you read the code of the statements, there are going to be no surprises. But especially for the tech sector, I think it's important. So let's take a look at that term, winning loser, from Sunrun. Sunrun is a solar company specializing in residential. The trend, this is the 6 points of how I find in stocks and how we trade together, is climate change. It has I love their business model. It's forward-looking in that you put Sunrun panels on your house, it's installed, and you pay by the month. And it's almost as if they're a utility in terms of the way you're looking as a consumer of their product about how you're going to pay for things. You can say it's grossly overvalued based on future cash flows. You can say it's fairly valued based on a return on capital, which is very important in their part of the industry. So it really depends, and that creates a roller coaster environment. And the roller coaster is related to government subsidies. The roller coaster is related to government crackdown on importing, using materials made by slave labor in China, which they were subject to and still are, I think to a lesser extent. The chains are relatively illiquid, which is why this was initially a core stock a couple of years ago, and now it's traded on your own or with me, but it's not a core that we're going to trade every week. And they're only monthlies available. And at present, because of what's been going on within climate change, China, solar, it's cash rates of return of 3% a week if you break down the premiums for selling a monthly strike, but that is not sustainable. You can take a look at the 1-year chart. It was $60. It went down as low as 20. This was elevated assumptions about what the Biden administration, to a lesser extent, European countries were going to do with solar. And here we saw, and again, this reflects that there's more than two different ways to value the stock. The 200-day chart is quite different. And it made it was time to, I've got a lot of emails. What are we doing with Sunrun? What are we doing with Sunrun? Why haven't we sold the call? This is the reason. Sometimes you have to wait. You wait for the market to put the risk on trade. More highly valued stocks, highly valued meaning high price earnings multiples or perhaps no earnings. And we got the pop. And so it was time to turn around and sell a call. Now, the company itself, it's a direct-to-consumer model, and it's monthly payments, as I said. It's vertically integrated. If you go to their website, you'll see happy employees in front of their van that says Sunrun on it. And so it's not just a panel manufacturer, it's a vertically integrated company with that business model that I discussed. It isn't necessarily generating huge amounts of money, but it's beginning to expand its markets. It has a partnership with Ford for charging stations where there are solar panels going into batteries, which in turn are going into charging stations for EVs. And so the company, is creative and is looking for new markets, and it's pretty big. So it stands a chance of being able to expand as the cost of solar continues to go down and opportunities continue to increase. And they had very strong third quarter results, which was evidenced by that chart. Those results, they use different financial metrics. So let's discuss these. They discuss subscriber value, which is ongoing value to the company based on projected future cash flows. Don't fall asleep while I say this. I'm going to break this down. The important numbers are where the arrows are, which is that the customer additions, okay, this is serious double-digit growth. And the concerns on Wall Street, will interest rates hurt them? You're charging month by month. It's a very, very different kettle of fish. Making a consumer decision is still much easier to buy a Sunrun installation than some other of their competitors. And look at the recurring revenue stream. And this is why I said it's hard to value the stock in traditional financial metrics. But this is $970 million with a basis of 17.6 years. You have a contract and transfers if you sell the house or whatever. But the whole value for them is we install, generate cash. We install, generate cash. Cash funds future installations as well as borrowing and so forth and so on. And that's the chart. It's from their website. And you can see the number of customers going up dramatically, and this means more and more cash flow. And that's why I like the business model. You're not going to unplug your solar power, obviously. So as they still have that 15, 20, 21% growth, the cash flow is increasing from all the customers as well as the new ones, and it's funding new business. It's not a bulletproof should subsidies hit a wall or whatever, but it's a very, very powerful business model. Their issue in the next 3 years will be material sourcing because a lot of subsidies in the administration's climate change package, which I think was $335 billion, have to be American sourced or mostly American sourced. The trading history, and this is why I use the term winning loser, is we're still well underwater. We had a cost cost basis above 44. And the bottom line is do you stick with it? And I want a climate change less solar to be actively traded as frequently as we can in options income blueprint. And I do believe that the valuation is off. I do believe Wall Street doesn't really grasp their business model nearly as well as they will within the next couple of years. So we sat on the shares waiting for pop, and we got a massive one. And the question, of course, will be whether it can be sustained. But this is the reason for all of you sending me emails going, when are we going to sell a call again? And here's what we did. So as you can see, the stock price was 31.72. It bounced off of near 20 a few weeks ago. The cost basis is here. We sell the $35 call, a big cash rate of return for a one-week trade. And the question is, will the rally hold? We have to see if we hold for 3 to 5 trading days above 30. But fundamentals, real world, great business model. Fundamentals for us, when a solar stock, an options income blueprint, or a climate change stock. Relatively illiquid, long-term perspective, weeds out all of you who just want to live Friday to Friday, which I hope is not the case. And I really see us doing quite well with this position, both from a cash point of view and getting back to where we need to be from a cost basis. Now, should in the coming weeks we get up to that $44, we'll book it and we'll close it. We'll take a breath and then we'll start over. It's in the training program. Whenever you're something deep underwater and you finally get back to break even, you take a breath. Do I still want to be in solar? Of course. Is it this stock? We'll see. And let me conclude. The companies and stocks like Sunrun are long-term plays. It's impossible not to believe in climate change, and it's impossible not to see a bright future, albeit with some government subsidies in some sectors for companies serving this market. And the other thing is there are times to watch and wait. Sunrun is part, for many professional investors, called a risk-on trade. I see the market going up. I'm going to accept more risk in my mutual fund that I'm managing. And this is a high PE or no PE stock. So now I'm going to add. And for us, it's a little unusual that only monthlies are available. But I want to repeat, we're going to continue to trade it, and waiting has paid off. Now this week, the Senate will be decided next week. I kept this on, by the way. The Senate was decided over the weekend. But I wanted to leave this here. It's not a typo, because of the second sentence. Doesn't matter to the market. The market really didn't care about the election. It cared about BTX, and it cared about inflation. And the House will still probably go Republican. And I did read some comments from Wall Street people on Wednesday, shocked that there wasn't a red wave. And political analysts were shocked, but the consequences of the economy were really not meaningful with the Democratic president. Even if the Republicans had taken both houses, something would have been vetoed that might have been advantageous to Wall Street investors or what have you. The bigger question is, will bullishness on rates related to inflation continue? Fed governors over the weekend went out of the way to say, hey man, it's not over. And more and more voices are saying it's time to pull back. We've hit housing, inflation is tapering. It's still much higher than where the Fed wants it to be. So I think there are too many bulls now in the bond market, which means, one sneeze from the Fed or a Fed governor going, hey, wait a minute, we're going to be raising rates for the first half of next year or whatever, could hit the market. And so this confusion means more volatility, and volatility is really good for us. And we're going to continue to sell puts that are well out of the money and close our positions early, as you've seen us doing for the past few months. This is Michael Schulman. Thanks for listening.